Hi, this is Randy Finney with the right side of the chart, and this is a closing market wrap for Monday, December 4th, 2023. So markets are now closed, and I wanted to do a brief update and start out with the equity markets. On that, very brief. Here's what I want to do in this order. Equity markets, quick update there. Bonds, look at the various bonds. Start with treasuries, that's probably most important, but of course I always keep my eye on corporates, munis, junk bonds, and all that. Quick update on the euro US dollar, and then time permitting I'll hit on a couple things that I'm looking at. Bitcoin went into at least GBTC, one of those Bitcoin proxy type ETFs. Hit a pretty good resistance level today with some divergence. Wheat still looking good, ag commodities. But if I can't get to those at the end, I want to focus on the big three, which are the stock market, bonds, and the euro US dollar pair, or either one, euro US dollar. Again, their dollar index is comprised 57.6% of the euro, so the euro is just a dollar in reverse, if you will. All right, this is one of the charts I got out to you today, the second one there, showing you some additional levels. I'll get to the other one I've been working on. I'm talking about the 60-minute charts since last week, pointing out this divergent high here. And we've been kind of stair-stepping lower since so far. We'll see, maybe just an ABC correction, maybe the start of something more. This is where we ended the day. Let me see. Yeah, my trades are turned off. After hours trades are off. So this is where we close the day right there. So I got that out to you for those interested. As I said this morning, if you expect more downside, then what you want to look for is to position. If you're looking to add shorts, initiate a new short, add back a short you covered, then you want to ideally do it objectively. When that means in a downtrend, you want to short a rally back into resistance. So that was that first resistance right there, about 386, a little over 386. And so we'll see what happens tomorrow. This one had a trend line a little bit different from the trend line on the previous 60-minute chart I've been highlighting. I'll get to that one in a second. And should we go up any more, the next logical resistance right there is the top of the gap right there, today's gap. We gap down. So, so far, so good, nothing big. We're about 3% off the highs in QQQ. So nothing more than a pullback at this point, but still the negative divergences are very much in place. Here's that other board. With the official targets, T1 was hit. This is often the case. On the initial tag of a price target, you typically get a reaction. That's what that is. You can see we hit it and bounced. And again, so this is that other board. That's why I got that one out to you today. I don't want to busy this one up too much. I'm just leaving the initial lines. This was an official trade idea with these targets I got out to you. So I didn't want to mark up too many lines. It starts getting cluttered up. So I'll just flip back and forth between these two boards there. So there's that trend line, which I think fits pretty good. That's how I had it drawn over here. And that one will come in with T2 if and when hit. And of course, if you trade futures like I do, then you can look at use NQ. I'll just move this over. We'll block that. We hit T1 today. It was a little bit below the first target there on NQ, and that's why I also post both of them. You wanted to keep an eye on both because sometimes when the first of the two to hit support or resistance, you have different subsets of buyers during the regular trading session, 9:30 to 4. You've got those that trade QQQ, both professionals and individuals. Almost all the individuals, but a lot of pros will trade QQQ as well. Even hedge funds will hold positions in ETFs instead of futures quite often, and then some trade this. So that's why I look at them both. Either way, that's that. So by that trend line, well, we just punched through it, but we're still above it, and really that's nothing really to update there beyond what I already got out to you. So far, we're just zigzagging lower. Like I said today, I favor more pullback, minor, or the counter trend bounces aside. Nothing goes straight down, especially coming off a move like this. I'm talking with strong momentum to the upside. Usually, you get this. First thing that happens is the momentum starts to stall out. Hence, that's why I always factor in these momentum indicators. That's what they are. They tell us momentum is waning when prices are going higher and the indicators making lower highs. That's negative divergence, and that foreshadows and often warns of an impending trend change, correction, just like divergent lows, which you want to look for to get long, right? Okay, so that's that. Let's go into... Before I leave the equity markets, what I mentioned to you in one of the posts today is at QQQ, now we do have that bearish PPO crossover. I've gone over it in detail recently, so I'm not going to spend too much time doing it today. Explaining it today and going over all the historical, since this really I'm looking at, you can go back in time, but I look for these big green hills and in conjunction with other things. That's probably the only thing I do want to expand on it that I haven't, might not have covered last week when I was talking about these big green hills. Typically, you want to see them, I have a line here. Those are the ones that really matter. But you can have these are green hills, and, where you want to maybe filter this out or not put such a weighting. Here's a great example. Back here, we had a divergent low. We had a bullish engulfing candle. I highlight that. So that was a 10 out of 10 buy signal, strong buy signal there with the positive divergence on the daily, on the 60-minute chart. So there's an example of a whipsaw, but one that you probably wouldn't have taken or wanted to take for that reason. So again, take it in conjunction with everything else. Like back here, when the market peaked, we had negative divergence. We had sell signals on the 60 minutes charts. We had negative divergence on this daily time frame. And then you had your first, crossover right here, right at the top. And then you had a little whipsaw, but that indicator went red again. And then, if you kept shorting the rallies throughout the bear market during that period of time, you would have, up into this one, you would have captured most of those legs down. And again, I keep saying this, it's not a standalone buy or sell signal, but it is a buy and sell signal. When I say buy signal, if it goes the other way, if you cross from, red hill, flips to green. All right, so that's that. I just wanted to mention that we had it today and that the track record overall has been pretty good. And again, it's been exceptional if you filter it and use it in conjunction with other things. In other words, when you see a bearish crossover on the PPO, if there's positive divergence and a breakout of a trend line and everything else, a lot of other things, then you may want to disregard that one or just kind of acknowledge it but not act on it. And as I mentioned today too in that post I got out to, they've all fired, all Mag 7 except Tesla. So you have Apple 3 days now, 3 consecutive days with the histogram red. Again, the histogram represents the bearish crossover on the PPO. Microsoft, day 4, so getting redder, if you will, meaning the PPO is continuing to move lower. Day 2 on Alphabet. Amazon, day 3. NVIDIA, day 5 right there. Meta, day 4. And Tesla, as I said, no crossover. That's the only of the Mag 7, but as I gave you a chart, there's just a whole mountain of resistance, including but not limited to the shorter-term downtrend line. That's the one I highlighted on the 60-minute chart that we've been getting rejected off of so far. And it also coincided not just a rejection off the trend line, but you also had that divergent high there. And then, as I mentioned in that post also earlier today, if it happens to pop through there, then you have an even more significant trend line. Why is it more significant? Well, number one, it's the primary downtrend line off the all-time highs in Tesla right there. So that's where all advances since the stock peaked have been capped, and so any pop there would give you, and I doubt we just blast right through it like it's not even there, so most probably reaction. So the upside appears limited, and to digress 1 minute, that's a good question. I want to just go to this comment here under the first post I made today when those price targets were hit. Scroll down. There's a couple I probably should highlight. Let me just start in order here. Somebody asked, thoughts on IWM, or can I review my thoughts on IWM in the next update? Absolutely, I'll be glad to. Not in this one. I said I would. Let me do it here. This is the answer. Might as well do it since I'm on it, and the video will go longer than I planned. Will do, but at quick glance, technically, meaning charts, when I say technically, that's charts, technical analysis. Fundamentally is macro or fundamentals. So technically speaking, IWM, just like the large cap indices, has negative divergence on the 60-minute charts and is approaching the 70, which is the oversold level on the daily RSI. Fundamentally, and that's the charts, and I'll show you that in just a sec. Fundamentally, the small caps might have a chance to rally and even outperform the large caps in 2024 if, and I get a bunch of little asterisks and big bold letters or caps, If interest rates fall substantially from here and the Fed extends the BTFP, that's the bailout for the regional banks, past March of 2024, which I will almost assure you they'll do. That's just my guess. They left it open-ended. I read it. I looked it up today directly from the Fed's website, and it said they'll guarantee that program, and said until at least March of 2024. So that means they're almost certainly going to extend it. They'll have to. Anywho, so they have to extend that. And there aren't any more shocks to the U.S. global financial system. Those fundamental bullish potentials, and they are certainly potentials, are on the table. They are not the most likely scenario, in my opinion, but with bullish divergence on the weekly chart of IWM and the fact that the small caps are much more dependent on borrowing than the large cap, those large cap stocks, those are some of the things to watch. So real quickly on that, if you're not familiar, large companies, think of Apple, Microsoft, those are mega caps, but anything, even in the S&P 500, those are considered large cap companies, mega caps. They're established companies, and they have a lot of revenue and earnings and cash flow. Most of them are positive, profitable companies. A little sidebar, the vast majority of stocks, and I don't know, it changes over time, but I believe at this point in time, you try to get a P ratio. There's no P ratio on the Russell 2000 like there is on the S&P 500 or NASDAQ 100, because the amount of companies, the 2,000 or so companies in the Russell 2000 small cap index, most of those have negative earnings or they're operating at a loss. They don't even have a P in the PE ratio. And so I think it nets out for those companies that are profitable. If they are, either way, so keep that in mind. But more importantly, where I'm going with this, interest rates are everything, because those smaller companies, a good percentage of the companies in the Russell 2000 rely heavily on borrowing, meaning issuing bonds, borrowing money to continue ongoing operations and for growth and expansion and all that. So it is all, I promise you, it is all about interest rates going forward. And we're going to get into that in just a second with bonds. But just to follow up, since I digressed already, might as well just take it home. There's the 60-minute chart IWM. There's the negative divergence. Say what you want about it. I know when it's, sometimes going up, people, the divergences always, but they don't always play out. I'll show you plenty of examples where they don't, but typically they do. Divergent low, rally, divergent low, rally, divergent high correction, divergent high correction, divergent low, rally. That's a divergent low. It doesn't say it there, but you can see the lines, and then divergent high. So that's what'll most likely happen on the 60-minute chart. The small caps are about to go down with the large caps, in my opinion. Daily chart, we don't have negative divergence. In fact, all we have is a very, very strong support, or significant support level, I should say. I don't call it strong, significant, whatever. It's about 163. I've highlighted it many times. And we just came off, you know what we had? I got to move that line. There was some RSI divergence there, but no PPO divergence. And again, they were saved by the bell, so to speak, when interest rates started pulling back recently. Make no mistake about it. I pointed it out, and again, you can check it yourself. Rates bottomed, rates peaked, started pulling back, and the stock market exploded. And these guys especially, because again, if the large caps and the stock market as a whole have been hypersensitive to rates, as they have, these guys are even more so. So let me, I was trying to measure it for you there with the rally. Is having a hard time with this charting program. You got to turn off the lines or you drag it and moves. Where's my pop-up box here? That's weird. There it is. It's been about a 16% rally in just a matter of weeks. And again, that had to do with the rates pulling back. So where rates go is where these guys will go, and even more so. So if we, again, 2024, we'll get to rates in a second here. Here's what I'm talking about on the weekly chart. It's a busy board, forgive me, meaning a lot of lines, but same thing. You can see we've had that. And that last low was ever so slightly a marginal new low. So you have lower lows with positive divergence on the indicator. So it is all about interest rates. And as I said in that comment, that reply I just gave you, here's a big box. This is a trading range. If 2024, or at least even just going forward from here, end of December, first quarter of 2024, if we continue to see rates fall substantially from where they're at, then you'll probably have more bang for your buck in the small caps for that reason. It's just a huge wind into their sails if rates can come back down, because a lot of these companies, even a lot of large caps, have a lot of debt coming due in 2024 and 2025 they have to roll over. So one to watch. Not my primary scenario, but certainly one I wouldn't fight, and I might jump on board if that's what is going to happen. Again, I'm going to get into bonds here in a second. I'm spending more time on the stock market than I wanted to, because I believe if you can nail it, the analysis on bonds, you can trade the market blindfolded, and that's been the case so far. Okay, on that, one more. This is one I wanted to get to. Just to clarify my comments. I know sometimes, that's why I do these videos. I can clarify things a little bit more. I know sometimes I said earlier something about a marginal new high certainly being a possibility. Number one, well, let me answer the question. Randy, I'm a little confused. Do you still think we can go for another marginal high from here? If so, what are the chances? If I choose to go long, what are the stops? Oh, I kind of misread that. I'm sorry. I thought he was saying if I'm already short, and I kind of scanned it. I'm still under the weather. You could probably hear it from my voice. I'm nasally, been coughing all week. Bad weekend for me, but I've turned the corner. I'm feeling a little bit better. Okay, so my answer. I put the odds of another marginal new high in QQQ or SPY as unfavorable, i.e. that means less than 50%. I most certainly can't rule it out due to the fact that the near-term and intermediate-term trends are clearly bullish. So that means, near terms, matter of the last few weeks, months. In really intermediate terms, the market bottomed in October of last year, and the NASDAQ 100 and most of those big market-leading stocks, really took off, started taking off in January. So those trends are bullish. So number one, without any solid sell signals, like I said, I'm watching the PPO indicator, my low volume sell signal. I wish we had a better trend line or price support level. I do have some very good ones I've shared with for months now with you, those purple levels on the Mag 7 and the QQQ, but we're comfortably above those right now. So this is what I'm trying to say. We have some sell signals. I think the RR favors being short. I know I'm digressing. I should just finish reading this, but I just wanted to clarify that when the trends are bullish, and you don't have any solid sell signals, you can't rule out another high. I can't even rule out a blow off top. In fact, I'd be a fool not to put it on the table. So those trends, near term, intermediate, are still bullish, coupled with the impulsive buying that followed the recent breakout above the downtrend lines on QQQ and SPY. I'm talking about the downtrend lines off the mid-July highs. Also, I'd imagine the mainstream media is going to start marching out the bull brigade to start fanning the FOMO flames and trying to get that fear of missing out going, telling everyone, oh, the Santa rally's coming, and then there you got the January effect with the small caps and blah blah blah. I mean, I've been doing this a long time. I don't turn CNBC on unless it's to watch a economic report. Just hear the report when it comes out right away. Or Fed meeting. That's about the only time I turn the TV on. Other than that, it's all noise to me. Anywho, I'm sure that's going on now, and if it's not, it will be soon. So there's that, and it gets it sucks a lot of retail money in, and so we could drift up. So summarize it by saying, all in all, it's not yet an all-in, short the market and throw away the key moment just yet. But as of now, as what I've been saying recently, the RR, risk-reward ratio, appears to favor being short versus long. So that's my takeaway, okay? And then I talk about the possibility of the blow off top, although I put the odds on that pretty low, but I wouldn't want to ride that one out short. So I'm taking it day by day for right now, but should today firm up that PPO sell signal? And it did. It firmed up, and SPY is getting close. Here, let me show you that. Since I'm all over the place, might as well just continue being all over the place. All right, SPY, daily, PPO. I already parked it, put it back up. See, we're close. I'd like to get that sell signal in as well on SPY. Some of the equal weighted is probably already triggered. And there you can see the PPO below, poised across, overbought, all that good stuff. Okay, moving on. To answer the second part of the question, which as I was doing this video, I just realized I answered it wrong. But I can do it in reverse. So the subscriber wanted to know if going long, what stops. The same levels, the same support levels and targets that I'm looking right now near term to be short, those are support levels that I think will be hit and targets. But if they're taken out, so like I like to say, support is support until it's broken. So any one of those, depending on how high your price are, I can't give you or anyone an exact recommend. I can't, first of all, can't give specific investment advice to anybody, but I can say, how much are you looking for on QQQ? If you're just riding out and you think there's going to be a blow off top and this market's got 10, 15, 20% or more to go by the end of the year, early into next year, because we're going to continue to rally or have a blow off top. Well, let's say you're looking at 15%. Then you're, a 5% stop loss below current levels would give you a 3-to-1 risk reward ratio. That's a favorable RR. That makes sense. You wouldn't want to give yourself a 15 or 10 or 15% stop. If you risk 10% to make 15, that's an unfavorable RR over time. Unless you have a very high success rate on your trades, you're probably going to lose money over time. So keep that in mind. That stops are commensurate to one's price target. If you're swinging for the fences and you're looking for a 30, 40, 50% profit on a trade, then you can give yourself an 8, 10, 12, or whatever percent stop. Okay, so hopefully that makes sense. And again, so I take that. That's where I start. What's the RR ratio? How much am I targeting? What are the probability of it reversing? And then I try to tactically set those stops slightly below a support level if I'm going long. Slightly depends on the security. I have to account for the market makers and the algos and the nefarious forces that are out there in the markets running. They know where the stops are. So I don't want to put my stop just below a support where everyone else has a stop, and that's where they're going to come and get them all. So I'll either be sometimes even above that. If they get even close to it, I figure they're going to go down through it. And sometimes I'll even put a stop a little above support that I don't think we should even go back to. Hopefully that makes sense. But there's so many variables, guys. So anyway, I've just, like I said, use those support levels, targets I've given on QQQ, a little bit below those. Let's keep that simple. Okay. And that was that. To answer you, okay. And then I answered the question, thinking I thought that I scanned through that and I missed the part that DevNat wanted to go long instead of short, so I answered it for someone who would be short, and I laid out that in last week's video, I believe it was, tight stop above the recent highs on QQQ, especially now that it's already fallen 3% off the highs. If you shorted last week around those highs, you could even put a stop at break even. an entry to assure at least a break even, no loss, if you're profitable by 3%. And then here, this kind of dovetails with what I was just saying. For those sharing my outlook that QQQ is likely headed down at least 40% from here, down towards that 235-ish level, so one of the long-term targets I had before the bear market even started back in 2022. That's the target I laid out and still maintain. So if you think the market's going to drop at least 40% sometime in 2023 and potentially lower, then someone that's thinking that, since there's not any hard sell signals on the market, it's not on, that person's probably building or scaling into a long-term swing short. Now we have divergences, overbought, we have sell signals starting to trigger, my low volume PPO crossover. So that person, again, their entry point's different if you're scaling in, and you shouldn't have a full heavy short position yet. But, I would say, as I've maintained all along before we even had this marginal new high, that we could see, potentially a 5-8% pop above the previous highs in QQQ. So that would, you could give yourself an 8 to 10% upside from roughly here, or where we were a few days ago last week, before stopping out, okay? And then that still gives you a nice RR on the trade. So you're risking 8 to 10% to make 40 or 50, 60%. That's an attractive RR. And I just added this. For a longer term trade like that, I'd rather at least have a starter position here, as I can easily see some kind of hammer down day come out of the blue any day now based on the technical posture of the market, especially QQQ and the Magnificent Seven, along with other factors such as fundamentals and sentiment. And that's going to segue into one more thing, one more post, and this is what I call my my mea culpa that I posted back here. So if you remember, if you've been here for at least a few months, I laid out the trade in treasury bonds and stated, which I often don't do. There's been a handful of times I said I've taken a significant portion. I had of long-term funds, 401k funds, where you can't trade actively because of trading restrictions, all that. You go into something, you're married with it. You can't jump in and out, or they get you with active trading restrictions and penalize you or don't let you back in. And so I said that's how strong I felt. And that was right at the lows on treasury bonds. So we nailed that one. And again, it was an overweight position, more than offset overall any losses I had by getting out early on the longs. I was also long in bullish treasury. The market back then, FANGs, covering shorts and all that. However, and then I kind of, again, this is dated back here, whatever it is. The post is dated November 3rd. And so this was the dilemma. This is what I was referring to here. So I'm just going to try to summarize. I won't read it verbatim. You can. But treasury bonds, long and bullish, is one of my largest swing and trend positions at this time, as my convictions are high that the 10 to 30 year bonds will continue to rally with yields moving lower. And as I've stated for months, particularly several months back, when all the bobbleheads on TV were singing the bull song for the stock market in July and August, right before it took one of the biggest drops. Remember, we peaked in mid-July. They were claiming yields had peaked and you should buy bonds then. No, we had another, I was warning we might get that another thrust up to new highs and yields, and it did. And that's what rocked the stock market. Again, one of the biggest drops coming off those July highs. And I also said that the stock market would become, and I used the word, hypersensitive to treasury yields. And it absolutely did. So that's that. And then, again, this goes back to November 3rd, a month ago today almost, a month ago yesterday. That brings me to today. My primary scenario still has a stock market most likely starting another major leg down. However, the problem with that is my bullish call on treasury bonds, that is yields continuing to fall in the coming weeks and possibly months, would, and almost certainly has been, it would be, what I was trying to say here is it would be bullish for the stock market. Yes, and just look what the stock market has done by then. I might have misphrased it there. So in other words, the stock market remains hypersensitive to yields, and that cuts both ways. Therefore, for the stock market to take another major leg down, my call for more upside in bonds, which means downside in rates, either needs to be wrong, and I went on to make clear, at least little sidebars here, and I feel stronger on my bullish call for bonds than my bearish call for stocks at this time. Remember, this was shortly after bonds made the turn, and I was long stocks, but then I turned around and got out too early. And again, that was the, in hindsight, I would have been long both stocks and bonds as I should have been. Or we need to see a disconnect between the recent strong positive correlation between treasury bond prices and the stock market. While I do think the latter has a decent chance of occurring, especially as we continue to see evidence building that the job market is finally rolling over, the million-dollar question is, how long will it take market participants to realize that it might be too late for the long-awaited pullback in interest rates to prevent what still appears to be an inevitable and relatively imminent recession that will impact corporate earnings, okay? I want to let you know, so nothing's changed there. I've used analogy like a hunter shooting his big game, and then it doesn't die right away. And I know it's kind of graphic for those of you that aren't into that, but they follow the blood trail, and sometimes they find the hog or the deer, 100 yards away or more. And so, and that's kind of the lag effect of what I'm talking about with interest rates. And I have very little, almost no doubt that it will happen. It's just there was so much liquidity. It's taken a while this time because the Fed supersized the stimulus, and so did DC this time around. So it'll be coming. But all right, let me just finish this. My guess is sooner than later, and I will spend the rest of the day digging into the charts, blah, 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 what I went on to say, including re-entries such as SOX short that we recently posted. So that one, that one's actually hanging in there, the SOX short. And so I concluded with this. If and when the positive correlation between stocks and bonds reverses to a negative or no correlation, meaning, bonds are going up, and stocks are
Market
going
data
down.
connection lost.
Remember, they've been highly positively correlated since the market peaked because of that hypersensitivity to rates, and that's unusual. Then that will most likely be due to a migration from this current mantra, buy stocks because rates are falling, and that is 100% what we've seen for this rally since over the last month or so.
Reestablished.
And then that will slowly morph into buy bonds because stocks are falling. In other words, a flight to safety bid to Treasury. So here's the and I also went on to say, and I've been saying this many times since, that's not going to happen in a single day. So I'm not today actually, well, no, Treasuries were down, and so was the stock market. So they're still trading together. But it will be, I believe, a gradual thing, and I'm going to watch that. It's a trend that I think will form over time. And so where am I going with that long rambled rant? Is that, I'm still maintaining a significant, I told you I took profits on some Treasury just because I had such a large position long term. And I was considering taking some out the other day. I'm talking longer term counting right now, guys, not short term. Short term, you can, in and out. This is TLT. So now it was a long segue, but we're here. We're going to get into bonds because, again, this is everything. So TLT, this is T3. That was hit last week. That's where we entered, right there at the lows. Hit 1, 2, 3. And there's my fourth and final target that I haven't taken off the table, but we still have. The technical posture has not changed. Only thing I did is tweak the uptrend line a little bit to make it fit better on these recent reactions. So we still have this wedging type action. And, we could continue up. But again, it's not much upside. So here's the thing. Near term, I see very little upside. And I'm open to the possibility. So let me say this. As bullish as I was on bonds back here at the end of October, right there, right before they took off, and as bullish as the charts still are, the same case I could make back then. Remember, this was just a 60. This was a hone down our entry, and we nailed it on the entry. But that was the bullish case to move money in a 401k and long-term funds was based on the weekly, daily, and even monthly charts. I'm going to go into those now. That case hasn't changed, and if anything, it only firmed up with a little bit of caveat. Let me get there in a second. The problem I'm having is, and again, I'm amazed nobody saw it back then. It was near 100% probability the Fed was going to pivot, that they were going to stop cutting. But yet, and it was priced in, and yet somehow the market waited till it was official, and then it took off, and now everybody's on board with the bull train right now in Treasuries. Everybody's saying buy Treasuries, yields are only going up, the rate hikes are over, which, again, if you've heard me, you probably heard me say this before in the past, I don't become contrarian just for the sake of being contrarian because something's going up and a lot of people like it. No, but when it is very one-sided, everything I saw a couple months ago, it seems everybody's seeing now. And it's almost too much, even if there is more upside. And I'm still have a decent position, and I'm going to keep that on because I have some shorts, semis and home builders and other things, and of course NASDAQ 100 and Mag 7. So this is becoming a one-sided trade right now, at least in sentiment, I believe. And I think I almost sense a rug pull coming here. A lot of folks piling in Treasuries. You can see the huge. It's not just it's not just the move up. Look at the volume in TLT. This is the biggest volume I think we've ever had, and on the buy side too. Typically on capitulation moves, it reeks of a selling climax, a big move down, but it wasn't. It was only a marginal new low. Selling climaxes, I need to address that for those of you who follow me or know technical analysis. Selling climax comes out on a prolonged move down. You would have had a selling climax, or there was a buying climax right there in TLT when COVID hit. That's what a buying climax looks like. You can see, let me turn off all the lines here. I think you can see it. I always have this turned down. I'll turn up my volume there. See that when you have that, just almost a parabolic move after a prolonged uptrend, in that it ends with a big surge in volume. That's called a buying climax, as the name implies. Climax done. and then that's boom, and that would have been, it was the best opportunity to short treasuries and probably in history right there. From there, the 30-year bond fell by almost like 53%. Okay, so could this be a selling climax? Yes, but it was a marginal new low. Yeah, you could say that's a marginal new high. I'm just, from my experience, especially the volume coming off the other side of it, it most certainly could be. And again, please hear me when I say this. I'm not shorting, on long-term accounts. I'm still have a heavy position, and I'm going to keep that on as a hedge to offset if I'm wrong and we get a blow off top in equities, and if I decide to hold on to some of the core shorts, that is, or at least for the time being. This can change tomorrow. If I smell a blow off top coming, and I'll let you know. Believe me, I communicate my thoughts to you on a near daily basis. So I just wanted to say that maybe it is, but I think at this point it just feels like sentiment has really rocketed right now, and I could see at any point in time just a smack in the face, just a surprise move, and maybe not. But let me focus here on the 10-year first. I'm going to go over the 10, 5, and 30-year. I have a lot of boards here, and I apologize for that. Let me just clean this one up. You can see here. Let me just draw it here with this busy board. Here's a downtrend line right here on IEF. Of all of them, if you're going to follow one, probably the 10-year, because they say that 30-year mortgages even track the 10-year Treasury bond closer than they track the 30-year. So the 10-year is an important one. I like to watch them all, the 5-year, the 30-year bond. But so there it is. That's a pretty good downtrend line. It's like you can see I drew it. You got reactions here, 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 and now here. So you're at resistance. You're not all the way overbought, but you know what? You're as overbought as you were right here and here. And almost right here, you can see that. So we're getting close to that 70 level. We're certainly getting up there. We know it's been a lot of folks piling in here. And remember, the market remains hypersensitive to bonds. And I promise probably even more so. I've seen that back off a little bit lately, where I've seen bonds down and the stock market's not reacting as much just over the last week or so. So I think it's almost what I see. It's becoming comfortable with the fact that rates are done. We've seen the peak in rates, and from here, inflation's just going to continue to fall, and the Fed's going to be cutting next year, and bonds are going to rock it up. That narrative is becoming pervasive right now. I'm hearing it everywhere, or pervasive, I meant to say. So, all right, here's the facts. We're at resistance on the 7 to 10 year. So with that, what I was trying to get at, and again, I'm still a little medicine headed here. I think we're gonna pull back soon. I think there's a good chance of it, a very good chance, pretty decent chance based on the 60-minute charts and everything else. And how far we pull back, there'll be a little bit where I think the market participants say, that's normal. We're a little near-term overbought on the short-term charts. And right there, maybe that's acceptable, where the market might not throw a complete tantrum. You start getting down anywhere near the lows on bond prices, which again is an inverse of the yields. That's where the bond prices peaked, or where the bond prices bottom or troughed is where yields peak. That is going to be that boom, hammer down moment. I can see it as a pretty decent possibility here. I'm going to show you a few more charts. So there's IEF. This is a daily chart. Here's what it looks like on the weekly chart. Again, a little bit busy, but I'm just going to show you the lines that matter to me. Again, these are things I've covered. This is a big, ginormous bullish falling wedge. There was the first downtrend line that was taken out, but we're at this downtrend line right here as well. And that's probably that same one I showed you on the daily. Big positive divergence. I mean, this is my kind of chart. And so that's why, again, if I had to freeze everything right now and they said, Randy, you've got to pick a trade, long or short stocks and long or short bonds, what do you want to be? For the next 6 months, you can't change it. I would be short stocks and long bonds. So let's just make that clear. And that's my current positioning. Of course, I don't have to do anything for 6 months, but that wedge can break out. And if it does, I mean, this massive. That's a 1 out of a scale 1 out of 10. That's a 10 for a target. I can tell you ultimately that wedge breaks out and nothing goes wrong with Treasury. That's where it's going. And That's just big, big, big. Look at that. It's just massive. It's just almost a magnet to me. I look at that and I'm like, there's the price target. If we can continue to rally in Treasury, there's where I'll be, reversing, going short, and where interest rates will probably go back down again if the charts confirm. However, first things first, we've got a downtrend line, which is resistance. We have a lot of bullish sentiment just skyrocketing, but I don't know if there's polls out there that show sentiment surveys and things like that for. I guess you could look at positioning from commercials or, puts and calls and things like that on the bond ETFs and stuff, but in the futures, of course. But there it is on the monthly chart. So there's your divergent low. But let me show you what I have here. Let me flip this over. I know I'm going longer than I expect to do here, but stuff's important to me. TNX. Let me start. I'm on the monthly, so we're going to just work our way back in. I just went out on IEF. I went from the daily, weekly to monthly. Now I'm on the monthly chart here. If you are new to right side of the chart, or follow me, this is I have them on the 30-year and the 10-year and pretty much in the 5-year. These are the downtrend lines. This was the biggest secular bear market in rates. Very well-defined downtrend line. And there's zero doubt in my head, or anybody that's studied the financial markets. My background's a business major, former stockbroker. This is 101 in the financial markets. Falling interest rates create a bull market and strong economy. So we were since rates peaked in the 80s, we've been in a bear market with falling rates, which is a bull market for bonds and a bull market for stocks. That ended at the COVID lows with the nuclear response from the Fed, brought rates down to near zero. Even the long-term bonds, not just federal funds rate. And anywho, and that trend line's been broken. That puts us in I believe, a new secular bull market by many metrics. However, this is long-term stuff. When I'm talking monthly charts, it can take years, decades to play out. This trend was 40-something years, the downtrend, and so that ended. So this is my kind of bullish near-term or intermediate-term bullish scenario for bonds. That says this is the uptrend line right here. We had negative divergence. We break down, but there is support right here. That's important to note. So if I'm getting a little bit granular, we broke down, and I think we can soon bounce. Yields, that means yields go up, but then ultimately come back down. At most, I see a back test of the trend line. And I think this fits my narrative. And this is what I've been working off now for at least, 6 months, several months at minimum, where there's that handoff, as I talked about earlier in the video, or the transition where we revert back to inverse correlation between stocks and bonds, where the stock market rolls over, the recession starts, becomes clear to all, corporate earnings start to fall, stock market's going down increasingly at an increasing rate. And then instead of that strong correlation with bonds and stocks, we start seeing this. We see yields fall, which again, guys, remember, if I'm looking at yields, that's bonds in reverse. So IEF tracks the 10-year, is the ETF that tracks the 10-year yield, which we're looking at here. And those two move up and down opposite. One goes up, the other goes down. So that would be bullish for bonds. But if we pulled all the way back there, that would be a great time. But it's so far off. If and when we get there, great. And I'll be looking at it then for a back test. But we have a lot of big support levels before then, mainly on this monthly chart. One right here, that's 4.50, which is a 4.5% yield. 4.05% yield in the 10-year, and then a 31.10, which is 3.11% yields, give or take. Call it right there, about 3.2, whatever. Okay, so that's that. And see the big divergences? Just like we had some big divergences here, and this is what I said, there was massive intervention when COVID hit. This is where bonds were set, I believe, to end their secular bear market, and would have if COVID didn't hit and Fed didn't do, and the federal government all-out nuclear response, which just kind of foiled the charts. But I've named that Ursa Interruptus, a bear market that was interrupted and prevented by the Fed in DC, but will ultimately manifest. It's just been delayed. If you have enough money, and there's only one institution in the world that can do it, or collectively the central banks, There's not any other individual or corporation that has enough money to change the course of, the financial markets other than the central banks. And they did it. And I think there's also a price to pay. Just like a doctor pumps too much adrenaline or epi into the patient that comes into the ER, you can pump some into them, you're going to get their heart rate back up and they might wake up, or you pump too much in them, you're going to overstimulate them at first. They're going to jump up, sit up straight out of the gurney, run around the room, spin off the walls and crawl on the roof, and then they're going to keel over from a heart attack. And that's what I think is going to happen here in the markets, but it takes, it's going to take a while to play out. So that's that. Drop down to a weekly. There's your wedge right here, negative divergence, uptrend line. So this was all, all of this was the reason I got so bullish on bonds and long lately, and we broke down. But look, here's the thing. So we broke down. I think everybody sees this. This is what I anticipated, positioned for, have been trading. But now we're basically, I have two lines here at about 4110 and 4300. It's really a support zone. We're right there right now. This was the previous high. This is when, remember what I said, everyone was getting bullish saying that the highs were in interest rates, and we got that last thrust up, and that breakout to new highs rocked the stock market, rocked the fangs, everything. All we're doing right now is we broke out and we're back testing. So what I have here on this chart, what I've added, this is new. If you're still with me now, I had this all along, showing you where I thought things would go, that we'd break down, there'd be a pullback in yields, we'd come down here, maximum target would be a back test of the trend line, maximum. However, let's just say that I'm right, but you want to see a big ass head fake that's going to just could potentially rock the markets. We bounce here off this back test, we go up and we take out the previous highs. You won't be able to get out of stocks fast enough. If we get anywhere near that recent high, that peak in yields, anywhere near it, I'm telling you what to do, but I'll be shorting anything with a ticker. And it won't even be. I mean, it would just take us back to where we were. But you can see. And if we do it, we'll probably pop up. And we could still do that and just have one more head fake. See these lines? These are my divergence lines. And it would still give us that maybe that one more thrust up, but the stock market will not like it at all. That I can promise you. And so there it is. So that's what it would look like. You'd still have some divergence because I drew these purple lines. The indicators here, the PPO and the MACD, could move up and still keep that negative divergence. So still have a pullback. So I'm watching for that. And most importantly, again, the takeaway is, I'll turn everything off for you. Remember, here's the previous highs in the 10-year. Right here, this peak right here, we peaked it there again, and then there was a breakout. And and the stock market didn't like it. So we're basically back testing it right now. So we're not out of the woods yet. And so that's why last week I told you I took profits on a decent chunk of my long-term bonds just to kind of lighten up. Let me show you that's the 10. This is the 30-year yield. Again, why we were long the 30-year, more juice. That's why I picked the TLT over and ZB over IEF. And this is the biggest drop in a while. But look at the chart. This was the all-time high right here, or a multi-decade high in Treasury yields in the 30-year. Tried to break it, flirted with it here, couldn't, and was testing, effectively testing that level, and then boom, a big breakout. And all this is a back test. So TA 101 says when you break out, even if you come back and then often you back test the breakout point and then take off. We could fall right through it, but I'm going to put pretty good odds that we're going to have a reaction. Good odds based on this. This is a daily chart. I'm sorry, I'm on the weekly, and there's the same thing as I just showed you on the 10-year. So here's kind of the uptrend line. Look, you can see we're just back testing right now. This 44-ish level, that's 4.4% on the 30. We're back testing it. We're at support. And yeah, there was negative divergence. But guess what? We could bounce off here, rally up, make a new high in yields, and still have negative divergence. It sets the stage for a bigger drop in yields, which again I'm probably getting 5 steps ahead of myself, but this is what I do to try to, what's my plan going to be if this happens? That could coincide instead of economic conditions easing. Everyone was worried when rates were going higher. This may be due to the stock market falling and economic conditions getting worse, And twofold. Two things would make yields go down. Number one, flight to safety. Institutions buying them. When you buy a bond, you're pushing the price up and the yield down through that buying pressure. And then also economic growth expectations, because we were in an inflationary environment, and if we really roll down quick, inflation's coming down pretty quick now. So and I can acknowledge that too. We could be in a deflationary environment, and that's going to be bad for bond. We'll see. I don't know where we're going to go. I'll take it day by day. All I can tell you definitively is the 30-year yield and the 10-year yield are at pretty good support levels here on those back tests. There it is on a daily chart. TLT is the proxy to trade it. I gave you right after I put the trade out when we entered it here, I gave you for longer term swing traders, if you didn't want to game those smaller multiple targets on the 60-minute time frame, I gave you just a first and minimum what I called high probability target, T1 about 91, 92. That's been hit. This is a potential T2. But again, it tells me why did I put that target there? Well, it was that previous reaction low. We're at resistance. All right, guys, that's it. I won't beat a dead horse. TLT at resistance. Maybe a little more upside if it wants to carry up, but then plenty of resistance overhead, including this downtrend line here on the 60-minute chart right there. Starts right there. I wanted to just, because I don't talk about it much, I do look at the 5-year FVX. There it is right there. That's what it looks like on the 5-year. The 10, like I said, is the most important. So here's the 5-year, a little bit under the back test, but it's got some, plenty of support there, and that's what it looks like on my weekly chart. So I can see another thrust up, the possibility of another thrust up as well. So we'll see if the other guys bounce. IEI, if you want to trade the 5-year and you use an ETF, that's what it looks like. It's the 3 to 7 year Treasury bond ETF. So positive divergence. So, like I said, I bonds still look constructive. I'm talking right now just a pullback, most likely coming. And if it does, that's going to continue to put pressure on the stock market. And depending on the severity of the pullback in Treasuries, 5-year won't move the needle as much as the 10, I think, and the 30. But if we get a pretty decent pullback, again, just easiest way to say this, it's incremental but almost exponential, if that makes sense. What I'm trying to tell you is how, if the pullback is this, okay, market stocks will probably react. If it gets down here, the closer you get down towards those previous lows on the bond prices, which are the highs in rates, then I think you'll see an acceleration of the response from stocks. They'll start to move faster and faster to the downside. Freaking out that we may see, because the bubbleheads will come back on TV and talk about, we might go some new highs in Treasury yields. And I'll tell you, it'll be devastating for the economy. There's just no doubt about that. Okay. Last but not least, I told you I'd do it. We'll have to cover the other things. I covered wheat last week for you. Bitcoin, GBTC, it's at big resistance. I'll cover that in another update. The last thing I gave you on Friday, was it? I think last week, is the euro. I told you it hit T1 when the stock market did. That was my first target. I gave you price targets. This, again, if you're new, I showed you the very strong positive correlation between the euro, EUR/USD, and the stock market, meaning they're positively correlated. If you flip it upside down or just look at the US dollar or UUP, they're inversely correlated. So it's a lot easier for most folks to just look at a positively correlated chart, trading together. So we hit there and said, target was hit. So as expected, we bounced. As we were bouncing, I said, look, I gave you a purple range in the video, said this is where it'd be objective to short the stock market if I bounce back. And then we hit it on Friday to the button right there. There was Friday right there, and it was the lower end of that potential bounce target zone, which I believe I said I favored shorting that. So we could go up here, you could short more up to the trend line, but that was it. So if you did that, then you were able to short QQQ when that was hit on Friday right here, and you made today 2%, and then you hit the first target and you could have covered that. So all in all 3%. So I'm just trying to illustrate how, make no mistake about it. There's Friday, right? This is a 60-minute chart. That's Friday where the QQQ, the last 4 60-minute candles ended. And then the euro, EUR USD. Right there, there's the daybreak line. So this was the end of day Friday. So you had multiple opportunities to use this to help align, shorting QQQ. All right, guys, longer than expected video. I'll just wrap up. I can just show you in a second. There's that level. This is a line I've had on Bitcoin, GBTC, the proxy ETF type instrument. It trades at a premier discount. I created that line back on October of, what was that? Oh, maybe I did put it in more recently than I thought. October, okay, a few months ago at least. Yeah, it's a key level, and we just hit it, negative divergence. I've been pointing out divergence. It hasn't played out, but that doesn't mean it's not going to. You have some pretty decent, even on the 60-minute chart, divergence here. I'd have to move these lines. That was stopped out. The last update I gave you, we shorted it here, I think, on that break. And that last update I gave you, I said, look, it's back testing. You'd probably want to put a stop not far above that high. So I'll consider it a new trade. I'll give you some new targets. I don't have a position now, but I'd probably take one tomorrow. Or wait for a sell signal. I like to either short rallies into resistance or wait for a sell signal. I wouldn't go all in. There's a strong bid on Bitcoin, but I think there's a lot of downside potential. And I just know with what's about to happen in the U.S. economy next year, there's no way in God's green earth the Fed or the global central banks are going to let Bitcoin get out of hand and siphon off too much of the fiat money that they need to keep printing and to keep their Ponzi scheme going. All right, guys, I'm going to wrap it up here and get this out to you. This has been Randy Finney with Right Side of the Chart. Have a great day.